Welcome back to our Investing 101 course where we teach you how to interpret key financial metrics. Today we're going to be looking at the price to earning ratio, commonly referred to as PE. The PE ratio is one of the most important and nuanced data points in financial analysis, but when interpreted correctly, can be one of the easiest metrics that can give you a quick idea of a company's value. It's a great figure to look at because it captures a company's size and their profitability all in one metric, which you can then compare against other companies. The PE ratio is the relationship between two metrics, price and earnings. Let's start by looking at each individually. Starting with the price, this represents the stock price that you would pay for a given company. Looking at Ford as an example, as of recording this video, the share price for Ford is just over $18, which gives us the P in our PE ratio. Now we can shift our focus over to earnings, and in the context of the PE ratio, earnings refers to the company's dollar earnings per share. The earnings per share, also referred to as EPS, is simply the company's total net income, aka profit, divided by the total number of shares the company has. You can think of this as how much of the company's total net income is each share entitled to. At the time of recording, the last EPS figure for Ford is $4.45. Some quick maths here will tell us that the PE ratio for Ford then is about $4.04. A quick note here as well is that you may come across a company without a PE ratio, or you might just see something like NA. The most common reason for this is that the company has no earnings, meaning that the denominator in our PE ratio is 0 or less. Showing a negative PE is typically poor form, so it's usually denominated as a blank or an NA. This lack of earnings is pretty common with younger tech companies or startups, which may post a net loss in their first several years as they build up their operations, making the PE ratio a less valuable metric when looking at those types of companies. But what the hell does all of this actually mean? Is a PE of Ford good? Is that bad? Well, at the simplest level, the higher the PE, the more money you're paying for each dollar of earnings. At first glance, you may misinterpret this as meaning that a high PE is bad and that a low PE is good, but that's not always the case for a number of reasons. One of the biggest reasons is that the PE ratio doesn't actually take into account the company's future growth potential and doesn't consider the company's level of maturity, as early stage companies will tend to have a higher PE. If the company's young, they may be constantly reinvesting this money, resulting in lower or even negative earnings. But if you're investing this money effectively, it may result in significantly higher earnings down the line, justifying the high price. Take a look at a company like Amazon. If you bought Amazon at any point in the past, it was a pretty damn good investment, seeing massive growth in earnings and price. But their PE as of today is sitting at 47, and believe me, it's been much higher. So then what's the point of looking at the PE ratio if low PE is good, but high PE can also be good? The key is in comparing the company to their peers. You get no value in comparing Ford to Amazon because they're involved in fundamentally different business lines and have nothing in common. In this case, we would want to look at other companies that operate in Ford's industry, and the closer our peers are to our target company, the more valuable the PE is in this comparison. So here, we would want to look at companies like Toyota, Volkswagen, General Motors, Honda, and things like that. This gives us a much better idea of where our company sits within their industry and whether they're a leader or laggard or just somewhere in the middle. When we compare Ford's PE to their peers, we can actually see that Ford has a much lower PE than any of their other companies in this group. With Ford, we only need to pay about $4.04 for each dollar of earnings, whereas the second best option in Honda costs us about $8.72 per dollar of earning. According to the PE ratio alone, Ford represents the best opportunity here. Now we can take this analysis and complement it by looking at other key financial metrics to get a holistic view of our company. As always, please let us know if you have any other questions in the comments down below, and I'll try my best to answer them as best I can. And let us know what other metrics and topics you'd like to see covered.